UPL Limited confident about its change in fortunes starting H2 of FY24. UPL Global Operations in Agrochemicals, Industrial Chemicals and Seeds. Growth story, organic and inorganic, achievement of backward integration, impressive revenue growth over 5 years, moving beyond 53,000 crores. 5-year CAGR, quite impressive, but last 1 year is a disappointment. NPAT fallen during the year, although 5-year CAGR is quite good. Latest year NPAT growth is -1%, a concern. NPAT percentage accordingly has fallen during the latest year. EBITDA percentage reflects a similar trend, falling to 19.3% during FY23. 3 strong geographies, Latin America, North America and Europe, contributing almost 2/3 of revenue. Shareholding pattern, overseas holding including FPIs, a sizable 42%. Promoters contribute almost 1/3. A strong company, global leader. UPL's cash flow highlighting effective working capital management, strong capital expenditure program, consistent, funded internally, dividend continuous but normal. Behind the strength is sizable net operating cash flow, supporting company's capital expenditure program in particular. PE comparable to peers, strong debt equity ratio and return ratios quite rewarding both in terms of return on capital employed and return on equity. Historically, Q1 contributes about 20% of revenue, about 23% coming from Q2, effectively H1 contributing about 40%, and Q2 FY24 is likely to be better as company expects inventory correction to be complete by the quarter, and in Q3 Q4 past figures indicate contribution of almost 60% of revenues, with the share picking up in Q4 in particular. In H2 of FY24, company foresees substantial volume growth, opening up higher potential of revenue generation. The movement on a normalized basis of market capitalization as compared to net profit after tax and EBITDA places market cap growth at the lowest level, particularly from FY19 onwards. The trend has persisted year after year, and in FY23 and thereafter in the latest quarter, once again market cap has been lagging behind, which in a way indicates potential for growth when earnings report substantial improvement. On a daily chart, there is price movement supported by volume at a level above 577.52 week low, taking the price to 635, which is closer to 23.6% Fibonacci retracement level of 642. And positive is the upward moving candles have been supported by volume. From a price action data, unidirectional movement of multiple parameters, average price, aggregate quantity, delivery percentage and quantity per trade, all moving upward together, indicating positivity and bullishness in the air and scope for bottoming out more brighter. Company has got an equity that has been rising consistently, but it inherits a sizable amount of debt. Debt equity recent balance sheet is at 0.6. Huge debt accumulated from multiple acquisitions in 2019 remained almost at a level beyond 21,000 crores, resulting in 60% debt equity ratio. While the equity is 40% of gross assets, external funds dominate in funding. Financial cost has been rising, eating up a major part of EBITDA. The rising finance cost has reduced the interest cover successively, recent year being at 3, adds to the risk profile of the EBITDA. Almost 1/3 goes to service the debt, which is a concern. Debt to EBITDA is almost 2 times. Over last 9 quarters, revenue growth for Q1, Q2 and Q3 FY23 have been quite effective and positive. Q4 on a bigger base has shown a very small increase, But the disaster has struck in Q1 FY24 with a negative growth of 17%. EBITDA percentage also has fallen during the last 2 quarters, taking the EBITDA percentage to the lowest in Q1 of FY24. The 2 quarters, Q4 of FY23 and Q1 of FY24, have been affected by recessionary market and volume realization has been down. And during the period, EBITDA percentage has been falling consistently, and even in terms of volume of EBITDA, Q1 FY24 has reported the least amount of EBITDA, and the EBITDA percentage has also been at the lowest level. Dealers destocking across the globe and China pushing its volumes at a lower price has hurt UPL in a very bad way. Agrochemicals player at the global level very strong flowback and effective capital allocation, achievement of both diversification and successful backward integration, but huge debt and accompanying cost is a burden. Chinese influence in terms of major volumes with lower prices dumped into the market is a constant worry for the company. Hope you will find this video on UPL to your expectations. I am Vitthal Prabhu with the weekly video on Stock Learning Simplified. You can access quality videos at our info card on Stock Learning Simplified. We look forward to your likes, shares and comments. If you are new to the channel, may please subscribe and press the bell icon for timely intimation on our forthcoming videos. For your valuable time and kind support, highly obliged. This video is for purposes of information, education and awareness only. This is not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever applicable, please seek the advice of a competent professional before taking action of any kind.